Hello everyone, welcome to the 151st episode of me learning how to trade in Forex. So in the last episode we went through the importance of planning ahead. Basically at this stage you should have a clearer picture of how you'll manage your investment process. You should know why you're investing, how much money and time you can commit, as well as how much growth you want to achieve and in what time frame. So there's risks involved with investing. You need to think carefully about everything that could derail your wealth building and develop a plan for how you deal with the situations should they arise. And then here's some tips that help you to plan for any future risk. So check the average returns of the market you plan to invest in. Consider how much you might lose. Know the right action to take. And then we went through the lesson summary. So now we're on to putting your strategy into action. So putting your strategy into action. Date is the 30th. Right, let's get started then. So choosing what you want to invest in is the fun part of the strategy. As you have learned from the beginner course, you can invest in more than just stocks or shares. Assets such as exchange-traded funds, ETFs, property, gold and many others can form part of your portfolio. In this part of the course, you need to start thinking about the kind of investments you want to make based on all the information you collated in the previous lessons. Make a short list, choosing what kind of investments to add to your portfolio. Choosing what kind of investments to add to your portfolio requires research, both of your own risk profile and of the markets. So research is required to when choosing what kind of investments to add to your portfolio. Both your own risk profile and of the markets. Research regarding your risk profile and of the markets is required when choosing what kind of investments to add to your portfolio. You can find out your risk profile using free online calculators. They work by asking you a series of questions about your age, life savings, investment, knowledge, and some of your habits, among other things. You'll then get an assessment of how conservative, moderate, or aggressive your risk profile is. So your risk profile can be found using free online calculators. Know how much risk you're willing to take on is important in deciding how much volatility you can accept. Know how much risk is important, how much volatility you can accept. So know how much risk you can take on, you're willing to take on, how much risk you're willing to take on is important in deciding how much volatility you can accept. In deciding how much volatility you can accept. Did you know volatility is a statistical measure of the amount of an asset's price changes during a given period of time? It's a popular way of assessing how risky an asset is. The higher the level of volatility, the more risk is associated with the assets. Simply put, highly volatile assets may see greater fluctuations in price over a given time period. So the higher the volatility, the more risk is associated, the more risk there is. At this stage, you need to work out which investments will give you the returns you need. To get to your shortlist, ask yourself, what asset classes do I want to invest in? These could include a broad-based index using an ETF, individual shares, bonds, property funds, and commodities. Is there a sector that interests me, or do I want to invest across multiple sectors? Are there certain companies I'd like to invest in? Am I willing to accept the currency risk from foreign investments? So, work out which investments will give you the returns you need. Give you the returns you need. Ask yourself, what asset classes do I want to invest in? What asset classes do I want to invest in? Is there a sector that interests me? Is there a sector that interests me? Or do I want to invest across multiple sectors? Or do I want to invest across multiple sectors? Are there certain companies I'd like to invest in? Are there certain companies I would like to invest in? Am I willing to accept the currency risk from foreign investments? Am I willing to accept the currency risk from foreign investments? So drop in currency values. Did you know currency risk arises when you exchange one currency to another at a less favorable rate? For example, say you're based in Europe and you bought US shares when the exchange rate was €1 or $1.2 for €1. If you sold your holdings when it was €1 for $1, it means you've lost some value on your investment returns. When you exchange one currency to another at a less favorable rate, you bought US shares when the exchange rate was €1 for one or $1.2 for €1. If you sold your holdings when it was 1-to-1, so you bought it at 1.2 and then you sold it at 1. So yeah, that's a loss because you sold it for less than you bought it. Yeah. So while asking yourself these questions, you should include a list of reasons why your chosen assets are good for your plan. Why is company X a better investment than company Y? Which one will better help you achieve your goal? If the answer is both, you still need to consider how much money you put into each one based on their performance, level of risk, and your desired returns. Include a list of reasons why your chosen assets are good for your plan. In a situation where the companies are closely related, from the same sector perhaps, you could be introducing concentration risk to your portfolio by investing both of them. In such a case, consider selecting best performing one of the two or splitting your capital equally between them. Concentration risk could be introduced when the companies are closely related, i.e. from the same sector. So if this happens, consider investing in the best performing one of the two or split your splitting your capital, or split your capital equally between them. Remember to note down the average annual returns of each of your potential investments for the same period as your investment horizon. Remember to note down the average annual returns of each of your potential investments for the same period as your investment horizon. If you plan to invest for 10 years, find out the average annual returns for each of the assets in the last decade. Note down the average annual returns for each of your potential investments for the same period as your investment horizon. i.e., if you plan to invest for 10 years, find out the average annual returns for each of the assets in the last 10 years. Start investing and refining your plan. Now that you've given thought to many of the variables that could affect your investment outcomes, you may well be ready to get started. One of the key factors in making an investment strategy work is keeping it consistent and not changing it too often. Not only can abrupt decisions derail your plans, but any changes you make in your portfolio may incur charges. It's better to adjust your portfolio during set periods in the year, whether annually, biannually, or quarterly. Less is better. One of the key factors in making an investment strategy work is keeping it consistent and not changing it too often. Not only can abrupt decisions derail plans, but any changes you make in your portfolio may incur charges. It's better to adjust your portfolio during set periods in the year. It's better to adjust your portfolio during set periods in the year. Less is better. You can, for example, set aside 1 day per year to go through your strategy again and reflect on how it served you in the previous year. During your annual review, you can make any changes you deem necessary based on market and economic conditions. Make sure you log them in your strategy documents so you can have a record of them. Changing your plan too often defeats the purpose of having one in the first place. You can think of your strategy as your North Star. It's there to guide your journey and help you stay on course when the markets get choppy. The next course will guide you through refining your strategy, i.e. an annual review where you go through your strategy and reflect on how it served you in the previous year. During the annual review, you can make any changes you deem necessary. You can make any changes you deem necessary based on markets and economic conditions. Ensure you log them, you log them in your strategy document so you have a record of them. Changing your plan too often defeats the purpose of having one in the first place. You can think of your strategy as your North Star. It's there to guide your journey and help you stay on course when the market gets choppy. The next course will guide you through refining your strategy. So, lesson summary. Carefully choosing the assets you want to tap into before putting your money into investing. Think about how much risk and volatility you can take on. A diverse portfolio could help protect your money against major losses. Invest in a range of assets across different asset classes, regions, sectors, and companies to mitigate your risk. A diverse portfolio could protect you against major losses. Invest in a range of assets across different asset classes, regions, sectors, and companies to mitigate your risk. The quiz. So, which of the following factors could negatively impact the price of an index? Declining global economic growth, increasing local corporation tax, investors' fears that its constituents are overvalued, all of the above. Which of the following statements is true about building an investment strategy? It has to be unique to your profile, yep. You have to use a special strategist to build one, nope. It should remain the same until you reach your goal, nope. Yeah. Having a strategy in place will guarantee that you reach your goal in your preferred time frame. False. You want to invest 10,000 once off into ABC PLC and hold your investment for the next 5 years. Your goal is to achieve 15% growth each year. Whilst doing your research, you find that ABC PLC has grown by 7.5% on average over the past 5 years. What could you do? Increase your initial investment amount, extend your goal date, adjust your profit goal to an achievable amount. Yeah, that. You invested in a FTSE 100 tracked exchange traded fund. An investment you intended on holding for the next 5 years. However, the market has been steadily declining for the past 6 months. What do you do? Sell your holdings to avoid further losses. Look at its performance over the last 5 years. Do that. Adjust your investment time frame. How does that help? You invested an investment, you tend to... Yeah, I think it's just this for now. You bought shares earlier this year in a global retail company that's been grown, has performed well for the last decades. A global pandemic strikes and you sell your stake, worried that it won't be able to trade as freely and thus lose money. You later find that the company has several pharmaceutical branches that remain open to serve people's healthcare needs. What's your opportunity cost? The potential rise in profits from the pharma branches, any future revenue growth that the company will experience, buy more shares at a lower price. All three. Which of the following is an example of a diversified portfolio? Local shares, not local. Local shares in both an oil company and an airline. Local shares in both a car manufacturer and a steel producer. Or government bonds and investment in global equity ETF. That one. Which of the following is not an example of a diversified portfolio? It's local shares. Because you're introducing what's it called? Concentration risk, don't you? Because they're all local. Which of the following benefits of having an investment strategy? Keeps a record of important details about investments, helps you adjust your strategy based on clear facts. No, it doesn't guarantee you'll reach your goal quicker. You have to save money for your investment capital because you can only finance your portfolio once off. False. So you can gradually trickle it in. 80%. Oof. An index's price is derived from all the companies that make up its constituents. All the factors above have the potential to negatively affect the individual share price of its constituents and thus drive down the overall index's value. Your strategy has to be in line with your goals and unique life and financial circumstances. While you can employ a financial strategist to help you with this, it's not a strict requirement, and you can draft your own strategy. Plus, your strategy will likely need to be adapted to the changing economic climate. Your investments could fall in value even if you've done your due diligence and chosen investments that seem promising at the time. Having a strategy only helps you stay disciplined and keeps record of your journey. That's what I clicked on, isn't it? Oh, okay, so it's basically right because I clicked on all three. All of the actions are appropriate. You could also find investment with your desired level of annual growth, but this could potentially have a higher risk. Remember, sometimes the market's downturn is temporary. By first looking at the FTSE 100 performance in the last 5 years, you'll be able to make an informed decision instead of selling or changing your strategy immediately. Yeah, okay, this one's right as well, all of the above. While the company's retail function might suffer, its pharmaceutical branch may experience a rise in profits and mitigate those losses. Plus, if it had a good history before this, it may bounce back once the pandemic is over. This means you lost your chance to increase your holding during a temporary price decrease, and you lose out on any future profits it might make. Airlines depend on good oil supply, and cars are manufactured using steel. If one or the other experiences a downturn, they could affect each other's profits. On the other hand, government bonds and global equity returns don't have a strong positive correlation. Spreading investments across multiple stocks helps improve diversification. Refer to the answer in question 7. Yeah, so basically the opposite of that. Question 7. B and C are correct, but your strategy won't accelerate your investment's progress. While it can improve the outcome, the markets can move against you at any time, whether or not you're prepared for it. You can add funds to your portfolio as many times as you like. I think that's all I didn't mean to go back, but yeah, that's all the quiz done for that. So, where are we on? I think we've just done this, haven't we? Putting your strategy into action. Yep, so we're just done building your own investment strategy. So, a beginner's guide to investing. Setting aside money for the future is important, whether you have hope to go on holiday in next year or retire in 20 years. In this course, you'll discover the benefits of investing your money over saving it in a bank and learn about the different investment options available. This will help you select the one that fits best with your goals, lifestyle, and available funds. You'll know the key questions to ask yourself before you get started and gain a better understanding of the risks involved and how to manage them. You'll also develop a broader knowledge of the investment landscape, helping you make informed decisions about committing your money to the markets. Nice. So, understanding the world of investments. Whoa, why is that like... Oh, no, that's annoying. '30th. So, saving and investing are two ways we can make the money we earn today work for us in the future. While saving is a great way to prepare for the big expenses in the short term, investing is a better option to work towards financial freedom over a longer period of time. Okay, so saving is a way to prepare for big expenses in the short term. Investing is a way to work towards financial freedom in the long run, in the long term. Many people have access to a savings account as soon as they open a bank account. You likely already have an account that earns interest on your cash. However, if you want your money to work harder for you over a longer period, investing in assets such as company shares, bonds, or property may be the answer. The key difference between saving and investing is in the amount of risk you take on with each one. So, key difference between saving and investing is the amount of risk you take on. When you put your money into a savings account, it will always grow under normal economic circumstances, and there's very little risk that you lose it unexpectedly. But the interest rate you receive is unlikely to be higher than the rate of inflation, meaning your cash is losing value in inflation-adjusted terms. Oh damn, okay, so when you put your money into a savings account, it will always grow under normal economic circumstances, and there's very little risk you'll lose it unexpectedly. But the interest rate you receive is unlikely to be higher than the rate of inflation. However, the interest rate you'll receive is unlikely to be higher than the rate of inflation, meaning your cash is losing value in inflation-adjusted terms. So your cash is losing value in inflation-adjusted terms. Because putting cash in a bank is less risky, savings are ideal for funding short-term expenses like holidays or deposits on a home loan. Putting cash in a bank is less risky. Savings are ideal for funding short-term expenses or deposits on a home loan. As a general rule of thumb, you should use savings accounts when you need to use the money within a short time frame, say 3 years. As a general rule of thumb, you should use savings accounts when you need to use the money within a short time frame. With investing, there's a greater chance that your initial investment could drop in value, But despite being risky in the short term, investments tend to earn more money in the long term than savings do. They're therefore ideal for expenses 10 or more years into the future. With investing, there's a greater chance that your initial investment could drop in value. However, investments tend to earn more money in the long run than savings do. As a general rule of thumb, you should use investing for funding long-term expenses. 10 or more years into the future. Setting targets for investments. Setting targets is an important part of investing. Setting targets is an important part of investing. You may have a single target at any one time or multiple aims over different time frames. For example, you might want to send your child to a good university in 18 years or buy a retirement home in a decade. Once you know what you want to achieve and by when, you can start thinking about what you would like to invest in and how much you wish to contribute. Once you know what you want to achieve, and by when, you can start thinking about what you would like to invest in and how much you wish to contribute. There's no instant result and you shouldn't be trying to get rich quickly. But with patience, consistent contributions and a readiness to take some risk, there's certainly the potential to get rich slowly over time, or at least achieve your financial goals for the future. For example, let's say you put £1,000 in an investment account that generates 10% returns, £100 per year. If for 10 years you take that 100 and spend it, you'd be left with just your initial £1,000 deposit, even though you've earned an additional £1,000. Now, let's say you leave all your returns in the account, rather than spending them. In year 1, a 10% return on 1,000 gives you £100, and the total investment pot is 1,100. So in year 2, you earn 10% of 1,100, giving you 1,210. This process is called compounding, and it's the reason why money that's been invested for longer earns more money. See if you can figure out how much money you have in 10 years' time with this short exercise. If you didn't withdraw any of your funds and a 10% annual growth remained consistent over the duration of investment, how much would you have in total by the end of year 10? So, you start off with 1,000. Year 1, 1,000. Yep, you start with 1,000, right? 1,000. There's a formula for this, isn't there? It's like, let me just get the calculator out. Good old calculator. So 1,000 times by 10%, that's 0.1 to the power of 10, isn't it? Something like that. So 1,000 times, let me see, 0.1 to the power of, how do you do the power on this calculator? To the power of 10. No, that's not how you do it. 1,000, what's the formula for compound interest? 1,000, oh no, times by 1.1 to the power of 10. So that gives you 2,593.74. 2,193. There we go. The total amount of your investment pot will grow by 10% of its total value each year, not just 10% of your initial deposit. In year 3, you would earn 10% of 1,210, £121 and so forth. By year 10, you'd have made an additional 1,593, making your total investments worth 2,593. The effect of fees and charges compounds in the same way, but with a negative rather than a positive impact. We'll talk more about this and other risks of investing later in this course. Compounding is the reason why investments work. The effects of fees and charges compounds in the same way. So let's a summary. Investing is one of the ways you can grow your wealth over time. You can invest in many financial securities, including company shares, government bonds, and property. Investing doesn't serve as a get-rich-quick method of gaining wealth, but rather requires patience and discipline. What is the stock market? What is the stock market? Date is the 30th. As the name implies, the stock market or stock exchange is the marketplace where shares in public companies are bought and sold. Market is a marketplace where shares in public companies are bought and sold. Its role is to give private investors a way to become partial owners of a business to benefit from the profits it generates over time. It also helps listed companies raise capital through investors that they can use to grow their business. Shares are listed on a particular market in a specific country, such as the London Stock Exchange in the UK. When a company wants to sell shares through an exchange, it has to apply to become listed. Once approved, it will have to follow the rules set out by the local financial services regulatory institution. So when a company wants to sell shares through an exchange, it has to apply to become listed. Once approved, it will have to follow the rules set out by the local financial services regulatory institution. For example, the Securities and Exchange Commission rules the US market. It requires that all publicly listed companies disclose their quarterly financial results 3 times each year and publish an annual report in the 4th quarter. This gives investors an overview of the company's financial standing throughout the year and helps them compare performance over certain periods before making any investment decisions. Buying a listed company therefore comes with a certain safeguard for investors. Did you know? Because of the SEC's financial reporting obligations happens 4 times a year, the reporting periods are usually referred to as earnings season. For many major companies, these reports are released around January/February, April/May, July, and between September and November. Earnings season reports outlay important details around a company's financial performance, so they often cause fluctuations in its share price as investors buy and sell their stock. For this reason, many companies release their results outside of the market hours so as not to disrupt the trading day. Companies who release earnings reports release them spell it. Many companies who releases earnings reports release them outside of the market hours so as not to disrupt the trading day. When an exchange is open, stock prices will fluctuate constantly as shareholders buy and sell shares based on the sentiment about the company's prospects and how investors react to economic and political events. Stock prices fluctuate constantly. Shareholders buy and sell shares based on sentiment about the company's prospects and how investors react to economic and political factors. Events, not factors, events. Shares in a company may go up or down at any time. Shares in a company may go up or down at any given time, but they usually respond directly to news about a business or the sector it's in. If a company reports increased profits, for example, or if it promises a dividend increasing faster than inflation, then its share price is likely to rise. But they usually respond directly to news about the business or the sector it's in. If a company reports increased profits, for example, or if it promises a dividend increasing faster than inflation, then its share price is likely to rise. I think I'm going to leave this episode here actually, because there's still quite a chunk to do, and I'm going to leave this for the next episode. So, yeah, in the next episode, we're going to finish off what is the stock market, starting with how can you invest in the stock market. So, thank you all for watching. Bye bye.